let's get more on what is at stake for this market. Bring in Tony Dwyer, the chief market strategist at Canaccord Genuity. Tony, always good to speak with you. I'll start off with the same question I just posed, Guy. What do you make of the markets? Gold at all-time highs. We got a weekly closing low on the 10-year yield on Friday. We're at 0.61% today on the 10-year yield. We've got the S&P 500 just about 5% off from record highs. I mean, what does this all mean?
Well, and thanks for having me, Mel, but to what everybody's saying, it's all about excess liquidity. Like, we're in a situation where the market went into a recession-based bear market following an inversion of the yield curve and a very clear credit crisis that was developing. And as opposed to what happened in 2007 and 8 and prior cycles, the Fed got on the game way faster than anybody thought they would, and they did it on April 9th, where they announced that they were going to buy some areas of high yield and municipal debt. And that's a big deal because that takes municipal debt issuance and protecting it to some degree, allows for state and local and municipalities to not have to puke credit to raise money if they have access to the market. So the way that the Fed has handled this and created extraordinary liquidity, and the game changer currently on the turn in the cyclicals, which I think is much more important than what we're even talking about, was when the OECD leading indicators, the OECD is an organization that tracks 37 global economies. 0% of them at the end of June were positive. 0%. The only time I could see that happening in their data going back, all the way back, was was in 2009. Now the data works with a 6-week lag. What's interesting, Mel, is 90% of those 37 economies are seeing a positive month-to-month change. So we've got historic liquidity, excess liquidity, and a synchronized global recovery that people are not yet believing in.
So, Tony, you came out a few weeks ago with a 3,300 S&P 500 year-end price target. And part of this call, you're saying that the markets are in a consolidation phase and pulling forward the assumption of a Biden win, raising taxes, Democratic sweep, et cetera. I'm wondering what's on the other side of this consolidation. It's just straight up, and how long do you think this consolidation lasts?
So let's take history, because my opinion isn't relevant. Let's look at the history. The history when the dollar goes down 8% or more. We did a study today that shows when it goes down 8% or more, it traditionally goes down double digits, anywhere between 13 to 18% since the 2009 Great Financial Crisis. It's happened 3 times. And all 3 of those times, you got the dollar so oversold, historically oversold like it is now on a 14-week stochastic, it created a counter-trend rally. So I wouldn't be surprised to see a counter-trend bounce in the dollar that would kind of churn the market a bit, especially the bigger cap names. And then you get another leg lower, which is hugely positive, not just for the market. So let's forget about the market index. Let's look at the cyclical and economic stocks. So when I looked at those 3 prior occurrences, from the peak of the dollar to the low of the dollar, and again, it was a double-digit drop in all 3 times, emerging outperformed, Russell outperformed, economically sensitive outperformed. They have lagged heroically so far. So I think the real call here, and my target's 3,300 plus, and it's important to say the plus, because I have no idea what you're supposed to pay for unlimited global Fed. Right? Is it 20 times? I think it's at least 20 times. Could it be 25 times? Sure. So I could come out with a crazy target, but it's more focused on the economic expansion, global economic expansion trade.
Tony, always good to speak with you. Thank you. Tony Dwyer, Canaccord. It is funny to think about a multiple based on QE infinity. I mean, I don't know how you do that. Brian Kelly, it looked like you were nodding your head in agreement with Tony there.
Yeah, no, I mean, that's exactly it. Like, how do you value this market when there's going to be unlimited amount of dollars printed? It's a crazy number, and you wonder why the market's going up, because it's being manipulated. I mean, it's as simple as that. They're buying investment-grade debt. They've taken all the risk out of the market. So, yeah, you buy equities in this case. You know, I do think what Tony's saying is kind of interesting, that, you know, you look outside the U.S. and you are seeing the countries that have the virus under control starting to come back to life, starting to get some economic activity. And that's probably relatively good, again, for the multinationals. Weaker dollar, those should do pretty well again.
Yeah. Jeff, time to look overseas?
Yeah, BK went exactly where I was going to go. Look, when you're talking about a weaker dollar, when you're talking about cyclicality, I obviously still question it here in the U.S., but when you look at the construct of global indexes, they're far more cyclical than they are here in the United States. So think about when the dollar really started to roll over toward the end of May. You have EM outperforming the S&P 500 by 10%. And to my point earlier about the U.S. being largely a service-based economy, and that's the sector of the economy that's most challenged right now, if you go abroad, it's the exact opposite. They're much more exposed to manufacturing and exports and things of that nature. So I look at data out of Germany today. I look at the fact that they're not dealing with kind of a very divisive election coming up. And I think that that in combination with the fact that you're paying cheaper prices, I think now is the time to look overseas. I know we've been saying that for a long time, but I do think that the weaker dollar, you're more levered to doing better internationally than you are here in the U.S.